Howdy swings. As we expected last week, both the minutes from the Federal Reserve's meeting and the speech by the Fed chair might encourage the market, and it seems they did help a bit as the market improved, recovering from Thursday's bear traps. Despite this positive effect, it appears that the boost from the Federal Reserve wasn't quite enough to push the S&P 500 past the 5650 resistance level, which was somewhat weaker than anticipated. Is there a chance the market might surpass the resistance and reach a new high? Let's take a look at Fullhapce's weekly swing market forecast to get some answers. Let's check this week's market index moves. The market experienced a broad increase. Interestingly, both the market and the VIX rose simultaneously, a phenomenon that traders might find noteworthy. S&P 500, 5,634.61, 1.45% up. Dow Jones, 41,175.08, 1.27% up. NASDAQ, 17,877.79, 1.4% up. Russell 2000, 2,228.1, 3.56% up. VIX Index, 15.79, 6.69% up. Let's take a look at the weekly sector performance. Overall, almost all sectors were up. Real estate was the standout performer, while energy closed slightly lower. Here are the reasons. Companies reported solid earnings. There were some mild and supportive changes in financial policies. There were signs of reduced inflation. Economic growth appeared stable. Here are the things to consider. Powell's speech at Jackson Hole was more dovish than expected, emphasizing a commitment to maintaining stable unemployment rates. The FOMC minutes indicated a cautious stance, suggesting potential rate cuts. This week's revisions by the BLS showed a significant decrease in payroll figures for the past year. The Atlanta Fed reported a slight decrease in business inflation expectations in August. U.S. weekly claims indicate that domestic employment conditions are relatively stable. U.S. PMIs for August showed a balance between strong service sector performance and weaker manufacturing. Eurozone wage data indicated slower growth, hinting at possible rate cuts by the ECB soon. Japan's national CPI showed a decrease, suggesting that the BOJ is not under pressure to increase rates. This week's earnings reports from various companies have been positive, hinting at a potentially optimistic end-of-year financial outlook. Here we present the weekly market forecast for swings. The likelihood of monthly market weakness is getting stronger and stronger, and a major market crash is slowly getting closer. Volatility is also increasing. On the other hand, the weekly bulls are in the midst of a strong weekly rally. Weekly resistance is at S&P 5650, and weekly uncertainty is moving away from critical. As we predicted last week, the market rallied this week and reached resistance near the S&P 5650 level. However, the pace of the rise was faster than expected, and although the S&P reached 5650 early, it ran into greater resistance than expected, making it difficult to predict the next move. It is possible that the market will not be able to break above this resistance, and the financial and biotech sectors will suffer a correction, with other sectors also experiencing downward pressure, leading to an overall decline. The financials and biotech sectors are the sectors with the most imminent correction of around 2%. While these sectors undergo a correction, the market is likely to suffer a decline of around 1% on an S&P basis early next week, starting August 26th, before recovering to close the week higher. Let's look at a few more perspectives that might help. Positive growth data has been somewhat encouraging. Central banks are taking a more accommodative approach to monetary policy. Fears of a sudden and harsh change by the Bank of Japan have diminished. Corporate earnings at the end of July were quite good. However, some challenges remain, such as slowing economic growth. Expectations for corporate earnings are quite high. People are willing to pay for stocks. Let's see the devil's advocate. The opposing scenario is that the market will plunge sharply and test the S&P 5350 support. In this case, bullish traders might check the Fullhapce forecasts and wait for the market to bottom out, potentially giving them an opportunity to buy more at a lower price. The rationale for this scenario is as follows. Technically, the market is back up to its all-time high, so unless we get some strong bullish news, we're bound to see a downturn and possibly even a double dip. Investors may already be considering policy easing by the FOMC and ECB. The Federal Reserve is concerned that labor market conditions are weakening, which could have a negative impact on economic growth. This week's revised employment data suggests that the economy may not be as strong as previously thought. And this week's Manufacturing Purchasing Managers Index, PMI, readings indicate continued weakness in manufacturing. Overall consumer spending may not be as strong. Corporate earnings have been released, suggesting that earnings may be weaker than expected. Tensions in the Middle East are rising, with little progress on a ceasefire in Gaza, and trade tensions between the EU and China are rising due to an investigation into Chinese imports of EU dairy products. There is a growing perception that neither Harris nor Trump has a strong economic strategy. Historically, resistance at all-time highs has been very strong and double dips have occurred frequently, so the opposing scenario makes sense. However, I am slightly leaning towards the view that the opposite scenario is not likely at the moment, as I think it would take shocking recession-related news to make it happen. Regardless, viewers might want to be careful about the concerns raised by the opposing side. Here is the conclusion. We have been predicting that while the monthly market is slowly turning for the worse, the weekly market will soon enter a full-fledged weekly rally phase. However, while the market has approached the S&P's all-time high of 5,650 faster than expected, it has encountered much stronger resistance than expected. What we expect is that we will likely see a steady rally only after a correction in the overdue financial and bio sectors. If the market pulls back early next week, starting on August 26th, traders may be wise to stay bullish and protect their assets, and then buy more when the financial sector drops by 2% or so. Also, traders may be prudent to consider both our main forecast and opposition scenarios to manage risk effectively. Thank you for watching. Fullhapce Intelligence, the best investment partner for swing traders.